All right, so this video I'm going to talk about some different types of bonds and some general features and characteristics associated with bonds. So first, let's start off by kind of classifying types of bonds by borrower. So we have corporate bonds. Corporate bonds are basically the borrower is a corporation and they are seeking to borrow funds. A municipal bond, the borrower is a state or local government. So think a city, a county, or a state. And sometimes they have some unique tax treatment, which has made them, in some cases, exempt from federal income taxes and things like that in the past. So that's something that sometimes makes municipal bonds interesting. Treasury bills, bonds, and notes are bonds for the federal government, so Uncle Sam. Treasury bills are shorter term in nature. So think maybe a year or something like that, a few months, something of that nature. Notes and bonds are going to be longer term, with the bonds being generally the longest term of all. International bonds are bonds from international entities. So a euro bond is going to be a bond from an entity or a borrower that is basically issued perhaps in the borrower's currency, but issued in the investor's country. So for instance, let's suppose we had a German company issuing a bond denominated in euros in the United States. So they're issuing the bond in the United States, but the bond is denominated in euros. That would be a euro bond. If that same German company issued a bond in the United States denominated in dollars, then it's denominated in the currency of the place in which it's issued, and that would be considered a foreign bond. So the main difference between the euro bond and the foreign bond is basically which currency is being used, whether it is the currency of the market in which the bond is being issued, in which case it'd be a foreign bond, or if it's a different currency relative to the market in which the bond is being issued, in which case it would be a euro bond. Now, there are some key features, kind of standard features for bond instruments. So among them would be the par or face value. So you can think of that as the amount that has to get repaid at the end generally. And when you actually had paper bonds, it was actually like printed on the bond. So sometimes it's called the par, or in some cases the face value. The coupon rate, that is the rate that is associated with the bond that dictates the amount of interest payments that will be made. So the coupon rate is used to determine the coupon payment. So if the bond has a par value of $1,000 and the coupon rate is 10%, that means the bond is going to pay 10% interest per year in the form of a coupon payment. Now, it could specify that it pays semi-annually, in which case it would pay 10% per year, but if it pays semi-annually, it would pay half of that every 6 months. So it would pay 5% for the first 6 months and then another 5% for the second 6 months. The maturity is going to have to be specified for the bond. So when does the bond come due? When does the borrower have to repay the par or principal amount? Basically, if you think about this, we've got all kinds of legal arrangements going on here where the borrower is agreeing to repay the principal, they're going to repay interest in certain frequency, when they're going to be repaying all this, etc. So this is basically a legal agreement or a contract. And so the name for that in this context is a bond indenture that specifies what all the details are and the conditions are and everything else. There can be various provisions associated with that bond indenture. Now, one of the things that can be associated with the bond are various restrictions, including subordination, which I'll come back to in a minute, dividend limits, possibly limits on ratios even, perhaps, etc. And so basically what this could specify is that if as a restriction or a qualification allowing the company to borrow this money through this arrangement, it may limit the company's ability to pay dividends to shareholders, for instance, or it may require they maintain a certain level of current ratio, for example. Subordination would basically be a provision that or restriction that specifies kind of how the bond relates relative to other bonds. So you could have a situation where a bond perhaps puts a restriction on its ability to be, can't be subordinated to other debt, or other bonds have to be subordinated to it, or something like that. A sinking, and I'll talk about subordination in a little bit more detail here in a moment. Sinking fund requirements. So basically, this would be a requirement that stipulates that the borrower has to actually start essentially repaying the loans in perhaps increments several years prior to the loan coming due. So if a company borrowed $10 billion for 30 years, instead of paying the full $10 billion off at the end of the 30 years, for the last couple of years of the loan period, a sinking fund provision would require that the company actually pay off a specified amount of those bonds over year by year for perhaps a couple of years leading up to that point. And basically the idea there is to enhance the likelihood that the borrower actually does in fact repay the full amount that was borrowed. You could have a kind of sort of collateral essentially specified for a bond. So if you think about it, the lenders have a claim on the assets of a firm generally. But some loans are kind of secured by specific collateral, and so they actually have specific assets that are pledged to back the loans. Other bonds are just sort of the general creditors of the company, which basically means they have a claim on the assets of the company. They don't necessarily have a claim on specific assets of the company. So if you had a claim on specific assets, that would be more of the secured type of bond. If it was a claim on the general assets of the company, but not anything specific, that'd be more the unsecured kind of scenario. Because you actually have to have basically all of these kinds of provisions going on, and who's actually making payments and things like that. There may be a trustee that is mentioned to essentially ensure that things are kind of carried out appropriately associated with the bond indenture and so forth. So sometimes that'll be specified. Also, kind of a key feature of bonds, when a company actually borrows the money, they have to convince investors to buy the bonds. And that's how they borrow the money. They offer these bonds for sale, investors buy them. That's how the company gets the money. Well, oftentimes companies will work with investment banks to facilitate that process. And so if they're working with investment banks to facilitate that process, investment banks don't work for free. They charge money, and that's going to lead to what's called flotation costs. So that's going to be the cost associated with getting the loan issued and out to the investor. And so it's kind of worth noting that there are flotation costs. It costs money to actually kind of complete it. If you're thinking of a sort of a similar kind of a scenario, imagine if you were taking out a car loan or a home loan, and they have loan origination fees and things like that. Basically that's sort of the same sort of idea that there's a cost to actually just going through the process of making the loan happen. And so in this case, that's the flotation costs, where it costs money to actually make the loan occur. Okay, so a few additional bond features and types and things that are important to know. Convertible bonds. Convertible bonds are kind of interesting. They have a provision that enables the investor of the bond to basically convert at the investor's discretion, convert the bond into a specified number of shares of stock. So what makes that kind of interesting is that means that the bond is sort of like a loan from the investor to the company. But normally, if you just lend money to the company, you don't really benefit a lot if the company makes a lot of profit, right? So if I lend money to a company and then the company turns into the next Google, Apple, Microsoft, whatever, turns into a huge company, I basically just get paid the principal and interest, and then that's it. If it's a convertible bond, however, as the holder of the bond, as the lender to the company, I could take that bond, hand it into the company, and convert it into a specified number of shares of stock, which kind of means that if the company turns into something really valuable, I kind of get to join that party and celebrate by turning this bond into shares of stock. And the reason why that's kind of worth noting is that means if you're trying to value a convertible bond, you kind of have to look at the fact that it's partially a bond, but it also is linked to the stock as well. So that complicates valuing that a little bit more. It's sort of a hybrid between debt and equity there. Callable bonds and puttable bonds. Let's talk about those. So a callable bond is a bond that the borrower can call in early, or basically pay off early. So if the borrower wants to, the borrower can pay off the loan early at the borrower's discretion. Now, sometimes for a callable bond, let's say it was a 30-year bond, it may not be callable for the first 10 years, and then it becomes callable after 10 years, and then the company can buy it back early if they want. Now, in many cases, if the bond is callable, the company that's paying it off early, they may have to pay extra interest, or they may have to pay more than the par amount to pay it off early. So that'll be specified in that bond indenture. It'll specify if it's called back at this point in time, here's what's going to be paid. If it's called back at this point in time, here's what's going to be paid, and so forth. But this is the callable bond is sort of an advantage to the borrower, because basically the borrower can pay off the loan at their discretion when they want to, as long as that call period is in effect. So that's advantageous to the borrowers. Not so great for the investor, And the reason for that is, imagine that the investor had lent money to the company when rates were 10%, and then rates in the marketplace dropped to 4%. Well, the company has a strong incentive to call back the bond, pay off the bond that or the loan that they'd borrowed money at 10%, and then reborrow at 4. So the borrower or company perhaps would basically benefit by borrowing now at a lower rate. The investor would have been very happy with it, that 10%, but now is getting all of their cash back, which they now have to invest at a lower rate in the marketplace of 4%. So callable bonds are really kind of an advantage to the borrower, not necessarily so great from the standpoint of the lender or the investor. Puttable bonds are basically we kind of switched roles here. So for the puttable bonds, this is a bond that has a provision in which the investor can sell it back to the borrower, or essentially demand repayment early at the investor's discretion. So in that case, if I had lent money to a company and I decide, you know what, I want my money back, I can go up to the company and say, hey, go pay off this loan. I want my money back. And if it's a puttable bond and that puttable provision is enforced, I can do that. So what that would mean for the borrower is potentially I might have to pay this loan off much earlier than I thought. So this is an advantage for the investor, not necessarily so great for the borrower if it's a puttable bond. Now, some bonds actually come with some extra provisions that are called stock warrants. And these are essentially like long-term call options. So let me just kind of give you the overview of basically what stock warrants do. So if I had a bond, the basic idea behind the stock warrant is there's an extra provision attached to the bond that might specify that, oh, by the way, because I own this bond, if I want to, as the investor, I could buy, say, 10 shares of stock at a specified price. And here's why that's attractive. As an investor, when I bought this bond and lent money to the company, maybe the stock is selling $25 a share, and there's this warrant that says, okay, I can buy 10 shares at $35 a share. Well, if the stock price is $25 a share, I'm not going to pay $35 to buy it from the company. But while I'm holding this bond, if the company increases in value and goes up to being worth $75 a share, well, hey, this warrant that enables me, the investor, to go buy 10 shares for $35 a share, well, that's mighty attractive now. So basically what that means is I, as the investor, have the choice for a bond that has stock warrants. I can go buy shares from the company at a specified price if I want to. So I don't have to, but I can if I want. And if that means as the stock price is changing, that actually affects the value of the bond that has these attached warrants to it. So not a lot of bonds necessarily have those, but if it does, then it kind of creates a situation where part of the value of that bond package is actually linked to that stock warrant, and therefore the stock price. Now, a little bit more terminology here. Debentures. So when you see debentures, just think kind of your run-of-the-mill ordinary bonds, basically. Subordinated debentures are basically still bonds, but they are subordinated or lower in priority to like the main debentures. So what that basically means is in the event the company goes bankrupt, the main debentures would get paid, then the subordinated debentures would get paid. So it's basically an order of priority. And what that means then is a subordinated debenture is going to have more risk than a regular debenture would. Now, a few other pieces. An income bond. This would be a bond that basically makes payments to the investors if the company has income. Now, normally, one of the benefits of a bond is that it makes payments sort of regardless, unless the company is about to go bankrupt, and therefore not able to make payments. So for an income bond, where they're going to make payments if the company has income, that kind of starts sounding progressively more like stock, and therefore it has more risk associated with it. So for an income bond, you're kind of blurring the line a little bit there between stock and bonds, and that now whether you get paid actually kind of depends on whether the company's profitable, which is kind of what happens with stock too. Mortgage bonds would be essentially bonds that are basically kind of serving as like mortgages. So you can have a couple different types of bonds. You're basically, it can be essentially you have a specific asset that's kind of behind it. So you can have some kind of specific asset behind that. And if you kind of broaden this, you actually have what are called mortgage-backed securities, which are securities that have a whole bunch of mortgages behind them. but basically the idea behind a mortgage bond is think that there's some kind of, it's like a mortgage on something. There's some kind of asset that's behind that, some specific asset, basically, is the idea there. And that's kind of where you get the idea of, collateral trust bonds. Again, there's something, some kind of collateral that is backing basically the bond. And as a result, that helps to ensure that if the borrower doesn't make payments, the lender can actually be made whole. You can also have kind of what are called equipment trust certificates. And those are basically going to be essentially bonds that are backed by equipment. And so essentially the company is borrowing money and they have equipment backing the loan, which is kind of like a form of lease, if you think about it. That's kind of what you have with a lease, where you're sort of borrowing money and getting equipment in exchange, getting a machine in exchange. So in this case, that's kind of what the equipment trust certificates are. It's basically kind of like leasing equipment, because you're borrowing money and using that money to kind of in effect get equipment, and that's what's sort of backing the loan. All right, hopefully some of these additional bond types and features and characteristics have been helpful. Thank you so much for watching, and have a great day.